Hello everyone, welcome to week 2 of financial management. This week we're going to discuss the 4 financial statements and some relevant ratios. So the first one is the income statement. This statement provides a financial summary of a company's operating results during a specified period. And although they are prepared quarterly for reporting purposes, they are generally computed monthly by management and quarterly for tax purposes. This is an example, and this is a 2-year example, so we can compare results. Income statements report revenue and expense accounts, and that's it, revenue and expense accounts. So we usually start off with sales revenue. If it's a company that has inventory, you will subtract the cost of goods sold, and this will give you gross profit. And then your operating expenses are subtracted from the gross profit, and this comes on down. You subtract all of the expenses, including interest expense and then taxes, and then you would get your net profit after taxes. Right here on this line is your net profit after taxes, okay? So we have gross profits at the top, which is your sales revenue minus your cost of goods sold. Then we subtract all of our operating expenses and our interest expense, interest that we might be paying on loans, things like that. And then we get net profit before taxes. Then we subtract our taxes, and this gives us net profit after taxes. The main thing to remember is that on the income statement is only revenue and expense accounts, revenue and expenses. Okay, now I know here at the bottom that they're subtracting dividends, but just ignore that. That's something they're just tacking on. That's not really part of the income statement. The income statement actually is going to end here where it says net profit after tax, okay? Next is the balance sheet, and this presents a summary of the firm's financial position at a given point in time. The statement of the balance is the firm's assets, which is what it owns, against its financing, which could be either debt, what it owes, maybe it's borrowed money, or equity, and that is money that was provided by the owners. So here's a quick look at a balance sheet. There's going to be 2 pages for this. Your assets are always listed first, okay, and these are things that the company owns. So they own their cash. They might own some marketable securities. This means stocks and bonds that they might be buying and selling with the purpose of making a little money quickly. You can look at this one and see that originally it was worth 51 and it's grown to 68. Okay, and then we have accounts receivable. This is an account that holds money that people or businesses owe you. So whenever you sell something, if you don't collect the cash right away, it's called an accounts receivable, and it's paid at a later date. And then inventory, whatever inventory they have would be listed. And these are considered current assets, and we would total those together to get the total current assets. Then we would list our fixed assets, things like land and building, machinery and equipment, furniture and fixtures, vehicles, things like that. And we would total those together. And then we would subtract any accumulated depreciation and get a net fixed asset figure. And then we would total all of that together, our current and our net fixed, and get total assets. The second part of the balance sheet is the liabilities and stockholders' equity. Liabilities are what we owe. Equity is what owners have contributed to the corporation, or also retained earnings. This is money that was earned by the business and has not been distributed. Okay, so looking at the top, we have accounts payable, and then notes payable, accruals, and we get a total liability, current liability. Accounts payable is going to be money that you owe, perhaps to your suppliers. Note payable would be something that you owe, say, to a bank for a bank loan. Accrual would be something that is accruing that you owe in the future. This might be something like a payroll expense, things like that. And then you have long-term debt. This would be debt that is owed and it's more than a year, okay? So your notes payable is typically less than a year, and then your note payable or your long-term debt would be more than a year, okay? And then we total our liabilities. Then we would list out any preferred stock that we have, any common stock that's been sold, any paid-in capital in excess of par on common stock. And then we also retained earnings, which recall is just money that the business has earned, but they haven't paid it out in dividends. It's just the money that they earn, the profit that they've earned from year to year, and they have retained that in the business. And then we total our stockholders' equity, and finally, we total our liabilities and stockholders' equity together. And as you can see in this first column here, it's $3,597. And if we go back a page, we see that our total assets are also $3,597. So one thing to recall about the balance sheet is that it represents the accounting equation, and the assets have to equal the total liabilities and stockholders' equity. And we can see here that it does. Next is the retained earnings statement. This reconciles the net income that's earned during a given year and any cash dividends that are paid with the change in retained earnings between the start and the end of that year. So here's a look at a retained earnings statement. We start with the balance in that account on January 1st. We add any net profit after taxes. You could go back to the income statement and see this would be the net profit after taxes. And then we list and subtract any cash dividends that were paid and total that together and subtract it, and we get our retained earnings balance at the end of the year. Next is the statement of cash flows. This provides a summary of the firm's operating, investment, and financing cash flows, and it reconciles them with changes in the cash and marketable securities during the period. The statement not only provides insight into a company's investments, financing, and operating activities, but also it ties together the income statement and the previous and current balance sheets. So this is a statement of cash flows. We have cash flows from operating activities, cash flows from investing activities, and cash flows from financing activities. So basically a company looks at every transaction and they ask, was cash involved in any way? And then they categorize it into one of these three categories. It's either an operating activity, an investing activity, or a financing activity. And then you just total everything up, and you will get your net increase in cash and marketable securities. Okay, I'm going to do financial ratios in a second video. I'll see you there.